In recent years, a business intelligence company has transformed itself into a giant Bitcoin whale. MicroStrategy, rebranded as Strategy in 2025, holds one of the largest corporate Bitcoin treasuries in the world. As of mid-2025, the company disclosed that it owned about 628,791 Bitcoins, purchased at a cost of roughly $46.07 billion. That hoard represents roughly 3% of all Bitcoins in existence. This strategy has delivered spectacular gains when Bitcoin's price rises, but it exposes investors to enormous risks when prices fall. In this video, we will explore why some analysts fear a MicroStrategy crash, whether the firm's Bitcoin buying resembles a pyramid or Ponzi scheme, whether its leader Michael Saylor could influence the price of Bitcoin, and how a collapse might affect the broader crypto market. Until 2020, MicroStrategy was known for selling enterprise analytics software. They helped other big companies analyze data, make charts, produce reports that put mid-level managers to sleep. The official story goes something like this. The company was sitting on a huge pile of cash, and due to inflation and low interest rates, that cash was losing its value every single day it just sat there. In August 2020, it began using its cash to purchase Bitcoin. Over the following years, it issued billions of dollars in convertible notes and equity to fund additional Bitcoin purchases. As of June 2025, the company reported holding 597,325 BTC, worth more than $42 billion, having financed much of this with $7.2 billion in debt. The correlation between MicroStrategy's stock and Bitcoin price was almost non-existent before the first Bitcoin purchase, but after August 2020, the correlation coefficient rose to 0.897, meaning the company's share price now closely tracks Bitcoin's movements. Investors pay a premium for this exposure. Analysts estimate that the stock trades at a significant premium to the net asset value of its Bitcoin holdings, with one report calculating a 112% premium. This premium is sustained by investor enthusiasm and by the company's ability to issue more shares and debt to buy yet more Bitcoin. During the first half of 2025, MicroStrategy's stock became extremely volatile. One analysis noted that the share price fell 47% between November 2024 and March 2025, dropping from about $543 to $287. Technical analysts warned that a break below $288 could send the stock tumbling toward $248, $208, or even $135 per share. The company's earnings have missed Wall Street estimates for 4 consecutive quarters, and critics argue that its core software business is deteriorating and now contributes little to cash flow. Meanwhile, the firm's enormous Bitcoin purchases are financed largely through convertible debt, preferred shares, and at-the-market share offerings. Analysts at a digital assets research firm point out that MicroStrategy's business model is highly sensitive to the price of Bitcoin. A sustained decline in Bitcoin's price could undermine the value of existing holdings and jeopardize future financing. An industry newsletter warns that MicroStrategy holds roughly 3% of all Bitcoins, financed by $7.2 billion in debt, and that its limited cash reserves and leveraged exposure make its balance sheet acutely sensitive to a Bitcoin decline. If MicroStrategy's stock premium collapses, and it cannot raise new funds, it could be forced to liquidate part of its Bitcoin holdings, triggering what analysts call a crypto liquidity crisis. Observers caution that such a sell-off could be bigger than previous crashes like Mt. Gox or Three Arrows Capital. Some critics have compared MicroStrategy's strategy to a pyramid or Ponzi scheme. They point out that the company issues new shares and debt, uses the proceeds to buy more Bitcoin, and benefits from the resulting rise in its stock price. Social media commentators argue that this feedback loop rewards early investors while exposing later investors to bigger risks if Bitcoin stops rising. One financial analyst warned that the cycle only works if Bitcoin keeps rising and called it unsustainable. However, Ponzi schemes involve paying returns to old investors using money from new investors without any underlying asset. MicroStrategy's approach is fundamentally different. The company makes no promises of guaranteed returns and invests in Bitcoin, a real asset with finite supply, while operating under corporate governance rules. A detailed analysis notes that MicroStrategy files quarterly and annual reports with regulators, discloses its Bitcoin holdings and debt, and undergoes audits. This transparency and regulatory compliance contrast with the secrecy of real Ponzi schemes. Moreover, Independent auditors confirm the existence of the company's bitcoins, and the board must approve any sale of digital assets. The company also uses multi-signature cold storage with US-regulated custodians to prevent any single executive from controlling the stash. Analysts therefore describe MicroStrategy as a high-risk leveraged bet, not a fraudulent pyramid. While the strategy could still fail if Bitcoin crashes, labeling it a Ponzi scheme oversimplifies the reality. Yes, it relies on Bitcoin's price rising. Like any investment relies on price appreciation. A Ponzi is defined by fraudulent payment flows, not hope for appreciation. At the center of this entire saga is one man, Michael Saylor. He is not just the CEO of MicroStrategy, he has become the high priest of Bitcoin evangelism. He argues it's the answer to inflation, the future of property, and the only rational safe haven for capital in a chaotic world. His conviction is absolute, and his ability to communicate that conviction is powerful. When MicroStrategy announces it's buying hundreds of millions of dollars worth of Bitcoin, that is a significant amount of demand. In the short term, such a large purchase can absolutely have an effect on the price. It signals to the market that a major corporate player has confidence. That can create positive sentiment and encourage others to buy, driving the price up. However, short-term ripples are a very different thing from long-term control over a global decentralized market worth hundreds of billions or even trillions. The Bitcoin market is vast, global, and operates 24/7. Bitcoin is a decentralized network governed by consensus among miners, node operators, and users. Even the largest holders cannot change the protocol, and attempts to fork the network would simply create an alternative chain that most users would ignore. What Saylor does have is immense soft power. His advocacy has convinced other companies and institutional investors to consider Bitcoin. He can't control the price with a button, but he can inspire a wave of buying that mimics that effect, at least temporarily. What happens if MicroStrategy is forced to sell? A forced sale, known as liquidation, could be triggered by a margin call on their Bitcoin-backed loans. This would happen if Bitcoin's price dropped below a certain threshold, making their collateral worth less than the lender is comfortable with. If they couldn't add more cash or collateral, the lender could sell their Bitcoin on the open market. A massive sell order would almost certainly cause a sharp, sudden drop in price. The market would have to absorb tens of thousands of Bitcoin being sold at once. Automated trading systems, panicked human traders, would amplify the effect into a cascade of selling as people rush for the exits. Short-term, a bloodbath. Long-term, more complex and debated. Even if MicroStrategy collapses, the Bitcoin network itself would be fine. Consider the lenders who have provided billions of dollars in loans to MicroStrategy. While a default would be a significant loss for them, the more pressing concern is how they would react. They might become far more cautious about lending to anyone else in the crypto space. If MicroStrategy's strategy ends in a spectacular failure, the boards and shareholders of these other companies would come under immense pressure to sell their own holdings to avoid a similar fate. A high-profile collapse would cause widespread panic. Many would likely sell their holdings not because of a change in Bitcoin's fundamentals, but out of pure fear. To truly understand the risks involved in MicroStrategy's strategy, we need to look more closely at how they paid for all this Bitcoin. They embarked on an aggressive campaign of raising capital primarily through debt. A convertible note is a type of short-term debt that can be converted into company stock later. It gave lenders a way to profit if MicroStrategy's stock soared while still offering loan protection. On the one hand, it allowed the company to acquire far more Bitcoin than with cash on hand, dramatically amplifying its potential gains. By borrowing money at a relatively low interest rate and investing it in an asset they believed would appreciate, they were trying to juice their returns. On the other hand, this debt introduces a huge element of fragility. Debt has to be serviced. That means MicroStrategy has ongoing interest payments that it must make, regardless of what Bitcoin is doing. Furthermore, the loans have covenants and conditions. Their Bitcoin-backed loans have margin call triggers. If the value of their collateral falls, they are on the hook. This debt-fueled strategy also complicates the investment thesis for shareholders. They are not just betting on the price of Bitcoin, they are betting that Bitcoin will outpace the cost of the debt used to acquire it. So, after peeling back the layers of hype, fear, complexity, what are we left with? At its core, MicroStrategy's story is not one of a Ponzi scheme, not a market-manipulating conspiracy. It is the story of a publicly traded company that made an unprecedented bold bet. It transparently and legally transformed itself from a software company into a vehicle for leveraged Bitcoin speculation. This is not a fraud. It is a high-risk corporate strategy executed in plain sight. Investors who buy the stock are signing up for this volatile ride. The risks are undeniably real and substantial. The company's fate is chained to the price of a single, notoriously unpredictable asset. Their heavy use of debt creates dangerous failure points like margin calls that could trigger a forced sale of their holdings. A collapse would be a significant blow to the crypto market, not because it would break Bitcoin, but because of the psychological shockwave and the chilling effect on mainstream corporate adoption. However, separate facts from drama. MicroStrategy is not a Ponzi scheme. Michael Saylor cannot single-handedly control the global Bitcoin market, though his influence as a promoter is significant. The company's strategy, while extreme, extends a belief shared by many. Traditional currencies are being devalued. Bitcoin represents a viable alternative store of value. They've taken this belief to its most logical, most leveraged conclusion. They are testing a hypothesis at a scale no one has dared, and the world watches the experiment in real time. Whether you view Michael Saylor as a visionary genius or a reckless gambler, one thing is certain. His company's journey is one of the most fascinating and consequential stories in modern finance. It's a high-stakes bet, plain and simple, with exhilarating potential for reward and terrifying potential for ruin.